Joining us, Bank of America Merrill Lynch U.S. equity strategist Jill Carey Hall and Leuthold Group Chief Investment Strategist Jim Paulsen. So Jim, what are investors' attitude right now when it comes to trade and just how much economic damage this is going to do and how bad it's going to get?
Well, I do think, Sarah, people are getting more and more worried about it as the tit for tat back and forth continues to escalate. And we got a big week with a lot of new tariffs coming on board. So it's getting, I think, more serious in investors' minds. You know, I really think trade is just one part of the bigger issue we may face in the second half. I think what we're really going to face is a slowdown globally and in the United States. We're going to peak out with a really good second quarter GDP number. Then I think we're going to probably slow to the low twos in the second half, and that's not on Wall Street's estimate right now for earnings. You know, you look at economic surprise indices, they're negative everywhere around the globe now, and they all came in the year at very strong positive levels. The U.S. surprise index just went negative at the end of last week. So I think we're focused on fiscal stimulus, but we're missing the fact we've had extreme monetary tightening, not only here but around the globe, and I think it's going to end up in a slowdown. Trade is part of that. Trade slows growth and raises inflation, and we may have a little bit of both of those problems, a little stagflation in the second half.
All right, so you've given us a lot to worry about there. Jill, against that backdrop of slower global growth, trade, monetary tightening, I don't even know what else Jim mentioned there, how do you factor in 20% plus earnings growth, which we're about to see in the second quarter?
Right. I mean, I think there's no question that the market has gotten a bit more concerned about trade. But we are looking at an economy in the U.S. that is very strong. Our economists just took up their U.S. GDP growth numbers. And I think we are going to see another strong earnings season. The consensus estimates are looking for 20%. We're thinking you'll see a little bit higher than that. So 22% is what we're calling for. And if you look at the indicators that have usually been predictive of a strong earnings season, economic surprises, they have trended down, as was just mentioned, but they were still positive for most of the quarter. U.S. GDP came in much stronger than expected. And the early reporters, which are mostly consumer and tech companies, they can actually give a pretty good read on what you're going to see for the full quarter. And we've seen between 80 and 90% of those surprised to the upside on the top and bottom line. So it looks like we could actually see a much stronger than expected quarter for earnings.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.